Lululemon's Q1 report is a clean example of why earnings season is not just about the headline beat. On the surface, LULU beat revenue expectations and delivered diluted EPS slightly above the selected consensus reference. But the stock reaction tells us what investors actually cared about. Shares dropped more than 11% after hours, and Reuters later reported a roughly 12% per-market move lower on June 5, 2026. The reason is simple. This quarter was less about what Lululemon just earned, and more about what management now thinks the rest of fiscal 2026 can support. The investor read-through is: beat headlines but guidance reset dominated. Start with the scorecard. For Q1 fiscal 2026, Lululemon reported net revenue of $2.472 billion, up 4% year-over-year. Against the selected estimate source at $2.43 billion, that is a directional revenue beat of about 1.7%, with medium confidence on the estimate side. Diluted EPS came in at $1.69 compared with the selected consensus reference of $1.67, a roughly 1.2% beat. Net income was $195 million on a GAAP basis, but the estimate support for net income is unavailable because the package uses an actual placeholder. So the defensible framing is not that net income beat. It is that reported revenue and diluted EPS cleared selected expectations, while the forward outlook changed the market's tone. The revenue line matters because Lululemon is no longer being priced like a story, where every quarter automatically proves strong demand. Net revenue of $2.472 billion was still positive year-over-year, and it was above the selected estimate. But the market was also looking for evidence that North America demand was stabilizing fast enough to protect the full-year model. Management commentary was mixed. Megan Frank said the quarter started solidly and showed some positive North America signals, but more recent headwinds led management to adjust the full-year outlook. That distinction is important. The first quarter did not collapse. The problem is that the company is signaling enough softness beyond Q1 that investors had to reprice the year. The income statement shows why the beat did not feel powerful. Gross profit was $1.339 billion on $2.72 billion of revenue. Cost of revenue was $1.33 billion. Operating expenses, normalized from selling, general and administrative expense plus amortization of intangible assets, were $1.62 billion, up 4% year-over-year. That is the pressure point. Revenue grew 4%, but operating expenses grew much faster. Operating income fell 37% year-over-year to $277 million, and GAAP net income fell 38% to $195 million. So even with a revenue beat and a diluted EPS beat versus selected expectations, the profit quality read is cautious. Growth is still there, but the operating leverage was going the wrong way in this quarter. Guidance is the center of this story. For Q2 fiscal 2026, management guided net revenue to a range of $2.450 to $2.475 billion. The midpoint, about $2.463 billion, was below the cited $2.6 billion consensus reference. Q2 diluted EPS guidance was $1.76 to $1.81 versus a cited consensus reference of $2.69. That is a much larger gap. Full-year guidance also moved lower. Management now expects fiscal 2026 net revenue of $11.0 to $11.50 billion and diluted EPS of $10.95 to $11.15. The selected full-year EPS consensus reference was $12.35. That is why the guidance reset overwhelmed the Q1 beat. Investors were not just reacting to one soft data point. They were reacting to lower expected earnings power for the year. The market setup made that guidance cut even more sensitive. Over the one-year daily close window in the data package, L fell from $265.27 to $114.23, a decline of about 56.9%. The closing high and low in that window were also $265.27 and $114.23, so the stock ended the measured period at the low of the one-year close range. Options context was also telling. The selected June 12, 2026 expiration implied about a $6.21 move, or 5.4%, using the closest to spot straddle around the 115 strike. The reported stock reaction was larger than that options implied move, which tells you the guidance reset landed harder than the market's near-term expectation band. Now put valuation around it with the right caveat. This is an educational PE times EPS framework, not investment advice or a price target. The data package uses a channel proprietary reasonable PE range of 20 to 30 times, with 25 times as the midpoint. Forward EPS estimates from Yahoo Finance were $11.22 for the current fiscal year ending January 31st, 2027, and $11.83 for the next fiscal year ending January 31, 2028. At 20 to 30 times those EPS estimates, the current year framework produces a range of about $224 to $337. The next year framework produces about $237 to $355. Against the current price of $114.23, the math looks optically cheap, but the market is clearly asking whether those forward EPS numbers and that PE range still hold if America's demand, margin pressure, and guidance revisions continue moving against the model. Management's message was not simply defensive. Andre Maestrini emphasized international community growth, product capsules, store and digital enhancements, while also acknowledging that more work is needed to reignite growth. That gives the bull case a structure. International momentum, product refreshes, and better execution could help stabilize the brand story. But the risk side is immediate. The key risk in the package is that America's demand and gross margin pressure worsen while tariffs, brand commentary, and product launch misses keep pushing earnings estimates lower. For retail investors, that means the next few quarters are about evidence, not brand nostalgia, not old multiples. Evidence that revenue can reaccelerate without sacrificing margins. The final takeaway is straightforward. LULU's Q1 fiscal 2026 results were not a disaster at the headline level. Revenue beat, diluted EPS beat, and revenue still grew year over year. But the full year guidance reset changed the conversation. Until investors see stronger demand, cleaner margin signals, and fewer estimate cuts, the market is likely to treat every beat as provisional. For this report, the headline was a beat. The story was the reset,